Good morning. This is Curt. I'm NAFCU's Chief Economist. With the Fed set to meet later this week, I want to talk a little bit about what they might be thinking and what some of the factors may be that play into their decision. So, as we consider the first quarter of 2016, there's been a couple of major market movers that could bear on the Fed's decision later this week. So the first of those would be China. We've certainly seen a lot of impact, at least in a market sense, here in the States based on sentiment over in China. Now, when we consider the situation in China, their stock market has actually seen much more significant turbulence than our own has. So starting in the second half of 2014, the Shanghai Composite gained over 125% in value. And in the 9 months since it peaked, it's since lost over 80% of those gains. So when we think about the decline that we've seen, I think a lot of that can be explained as a market correction. That significant rise that we saw was in a lot of ways fueled by increased trading on margin. PE ratios were at historic highs, and so it's not necessarily surprising to see the stock index in China lose some of that value. With that said, there has undoubtedly been some souring of sentiment about China's prospects going forward. But I would stress a lot of this sentiment is focused on the manufacturing sector and some of the slowing that we've seen in that sector. But I think it's important to keep in mind that China is in the midst of a transition where they're attempting to pivot their economy away from being so focused on exports and manufacturing and towards one that's focused more on consumption and the service sector. So from that standpoint, it's not necessarily surprising to see some decline in manufacturing activity. One area that does give us some concern is in terms of how the government has responded during this period of decline. And they've responded in some ways that are sort of traditional responses to an economic slowdown, but they've also responded in some more untraditional ways. And so I think that has given rise to some of those fears and uncertainty that we've seen regarding China. I think going forward, though, there's a lot to be optimistic about. And if Chinese policymakers get things more or less correct, then I think it's likely that some of these fears about China are misplaced. Another big issue has been oil. Oil has certainly impacted financial markets here in the U.S. We've seen a pretty significant curtailing of oil exploration, which has impacted GDP here in the U.S. With that said, oil production has not necessarily declined by so much, and that's because a lot of these extraction techniques have allowed for production to stay at their current level or close to it for a longer period of time. And so because of that, we've seen oil prices continue to stay at their current levels despite the fact that exploration has declined by so much. So the good news is that analysts tend to agree that we've basically bottomed out in terms of oil prices, but considering that production is forecast to stay at its current level for a longer period of time, we don't expect any meaningful rises in oil prices well into 2017. From an economic standpoint, the question really is what are consumers doing with the savings at the pump? And to the extent that they are spending that money, that would tend to offset some of the headwinds that are created by this drop in oil exploration. The good news is that we have seen some evidence that consumers are spending those savings. Despite the fact that we have seen an increase in the savings rate, for the most part, it appears that consumers are spending that money. Now, what does this mean for the Fed in terms of its decision later this week? And I think in a lot of ways, the situation the Fed finds itself in now is reminiscent of where they were back in September, when they were considering the initial rate increase. And really, economic conditions would have supported that decision in September to raise rates. However, financial markets were in a lot of turmoil at the time, and as a result, we saw the Fed delay that initial rate increase until December. So I think as we consider the Fed's decision later this week, I would expect the same thing to occur. The Fed is probably going to hold off on a rate increase, despite the fact that you could really make a pretty strong argument from an economic standpoint to do so. I think the Fed is probably going to wait until the second quarter and most likely June to go ahead with that second rate increase. So with that said, I invite any questions or comments. You can reach out to us at research@nafcu.org. And with that, I bid you a good day.